I was rereading the history of Federal Express and a problem from their early days. The central hub was in chaos every single night because they could not get the packages sorted and the airplanes loaded on time, and the entire system was threatening to collapse. They tried everything to fix it, screaming at the workers, begging them, threatening them, but nothing worked and the planes were always late. Finally, someone smart looked at the compensation system and realized the workers were being paid by the hour, so they had no incentive to finish quickly. They changed the rule so that once the shift was done and the planes were loaded, workers could go home with a full night's pay. The facility began running perfectly, proving a basic rule of human nature I've been shouting about for 50 years. Show me the incentive, and I will show you the outcome. Look at the recent wreckage at Jaguar, a historic brand destroyed in a week by incompetent leadership targeting an audience that doesn't exist. Now, when a CEO like the one at Jaguar resigns to pursue other interests, the financial press nods along like a bunch of bobbleheads. In the real world, we know what that means. He was fired for incompetence, the modern equivalent of the board handing him a revolver and a bottle of whiskey. But the terrifying part is not the firing. It's that he likely walked away with $50 million in severance for doing a terrible job. We have created a corporate culture in America that is frankly insane. With such perverse incentives, it is a miracle any of these companies survive at all. You are sitting there looking at your portfolio thinking you are the owner of these businesses, but you are not the owner. You are the patsy at the poker table. The people running these companies have no interest in your long-term wealth. Their interest is to hit a quarterly target, trigger a bonus clause, vest their stock options, and then get out of town before the sheriff arrives. If you do not understand the agency problem, the conflict between the owners of the capital and the managers of the capital, you are going to get fleeced. The principal-agent conflict is the single biggest risk to your money outside of your own stupidity. The market is currently filled with hired hands who are treating public companies like their own personal piggy banks, and they are doing it with accounting tricks that would make a carnival barker blush. You hear them talk about EBITDA and adjusted earnings, and you nod your head because it sounds sophisticated. It is not sophisticated. It is rat poison disguised as a steak dinner. If you look at the way modern executive compensation is structured, you will see a machine designed to transfer wealth from you, the shareholder, to the management team, regardless of performance. And the worst part is, you are cheering for them while they do it. Let us look at the argument for this madness, because I want to be fair before I dismantle it. The compensation consultants will tell you that this is all necessary to attract top talent. They will say that running a multinational corporation is an impossibly difficult job, requiring a singular genius, a Superman CEO. They argue that if you do not offer a package worth $100 million in stock options, the talent will go to private equity or a hedge fund. They also argue that giving management huge amounts of stock options aligns their interests with yours. The theory is that if the CEO owns a lot of stock options, he will want the stock price to go up. And since you want the stock price to go up, you are both rowing the boat in the same direction. This is the standard dogma taught in every business school, and on the surface, it sounds rational. It sounds wonderful, doesn't it? It is also complete and total garbage. This alignment of interests is a lie that has cost investors trillions of dollars over the last 3 decades. When you give a man stock options that vest in 3 years, you have not made him an owner. You have made him a gambler with other people's money. An owner cares if the business is still standing in 20 years. An option holder only cares if the stock price is higher on the specific day his options vest. This creates an incentive not to build a durable business, but to manipulate the share price in the short term, often by destroying the long-term value of the enterprise. We see this constantly with share buybacks. Now, I love a good share buyback when the stock is undervalued. It is the most tax-efficient way to return capital to owners. But what we see today is companies borrowing money at 5 or 6% interest to buy back their own stock at record-high valuations. Why on earth would a rational manager buy back stock when it is trading at 30 times earnings? The answer is simple: because buying back the stock reduces the share count, which artificially inflates the earnings per share, which triggers the CEO's bonus package. He is literally hollowing out the company's balance sheet to ensure his personal check clears, and when the recession hits and the company needs that cash, he will be long gone on his yacht in the Mediterranean. Then there is the issue of stock-based compensation, or SBC, which has become the dirty little secret of the technology sector. You look at these tech companies, and they report non-GAAP earnings that look fantastic, but they have conveniently excluded the cost of paying their employees in stock. They tell you, ignore that cost. It's a non-cash expense, which is the most asinine thing I have ever heard. If I pay an employee in cash, it's an expense. If I pay him by printing new shares of stock and handing them to him, they say it costs nothing. But it costs you, the shareholder, everything, because your ownership stake is being diluted every single year. It is like slicing a pizza into more and more tiny slices and telling you that you have more food because you have more slices, while the manager eats half the pie in the kitchen. If you are investing in a company where the share count is growing by 3 or 4% a year just to pay the management team, you are running up a down escalator. You have to gain 4% just to break even, a hurdle that is very difficult to overcome over a long period. I liken it to the behavior of the South Sea Company directors in the 1720s, who hyped a sham business, sold their own shares into the frenzy, and left the British public holding the bag. Human nature has not changed one iota in 300 years. The only thing that has changed is that the thieves now wear better suits and have better accountants. They use terms like synergy and strategic realignment to mask what is essentially looting. I remember looking at the Nifty 50 mania in the 1970s, and even then the accounting was more honest than it is today. Back then, if you lost money, you reported a loss. Today, if you lose money, you simply adjust it out and call it one-time restructuring costs. I have never seen a company that has one-time costs every single quarter for 10 years, but that is what passes for normal in Wall Street today. They treat expenses like they are optional, like they are a matter of opinion rather than a matter of arithmetic. You need to apply the productivity test to the management team just as you apply it to the asset itself. Is the management team acting like a gardener, tending to the soil and waiting patiently for the harvest? Or are they acting like a locust, stripping the field bare and then moving on, a behavior incentivized by the modern CEO's short tenure? They come in, they slash research and development because that saves money today but hurts the company in 10 years. But they don't care about 10 years from now. They fire the experienced staff to hire cheaper labor, destroying the culture but boosting the margins for a few quarters. They lever up the balance sheet with cheap debt to pay dividends they cannot afford. And then, when the inevitable collapse happens, they pull the cord on their golden parachute and float away to safety while you crash into the rocks. This is why Warren and I have always preferred to buy businesses where the management is part of the furniture. We like the family-owned business, or the founder-led business, where the guy running the place has his entire net worth tied up in the stock. When a man's name is on the building, he tends to be a little more careful about how he treats the reputation of the firm. He cares about what the business will look like when his grandchildren inherit it, not what the analysts will say on the conference call next Tuesday. The greatest compounding machines in history, Costco, Walmart, Berkshire Hathaway, were all run by fanatics who treated the shareholders' money as if it were their own, because a lot of it was their own. They didn't need stock options to align their interests. They were aligned by blood and by honor. But you look at these tech darlings today, and the founder sells stock every single week. They call it programmatic selling, for diversification, or tax planning. Rubbish. If the guy who built the rocket ship is selling his ticket, why are you buying it? If he thinks the stock is overvalued, he is selling it to you, and you are thanking him for the privilege. This is the Greater fool theory institutionalized by the compensation committee. They are passing the hot potato to the pension funds and the retail investors, and the music is eventually going to stop. I was reading about the fall of the Roman Empire recently, because I am 99 and I don't have time for TikTok, and the parallels to our corporate governance are striking. Towards the end, the generals and the administrators were more interested in looting the treasury than in defending the borders. They debased the currency, they neglected the infrastructure, and they threw lavish games to keep the populace distracted. Today, the debased currency is your stock dilution. The neglected infrastructure is the R&D budget, and the lavish games are the quarterly earnings calls where they promise you that AI is going to solve everything. It is a lollapalooza of bad behavior, and it is driven by the fact that we have separated ownership from control. The passive index funds, BlackRock, Vanguard, State Street, they own 20% of these companies, but they don't act like owners. They rubber stamp the pay packages because they don't want to rock the boat, and they collect their fees regardless of whether the company performs or not. You must look for the insider buying column, not the insider selling column. If I see a CEO reaching into his own pocket to buy shares of his company on the open market, that is the only signal that matters. It means he believes the math is in his favor. But if I see a company where the CEO is paid $50 million a year, the company has not made a profit in a decade, and he is selling stock as fast as he can vest it, I would not touch that stock with a 10-foot pole. I don't care if they have the best AI technology in the world. If the governance is rotten, the equity is a zero. You have to learn to read the proxy statement. I know, it is boring, printed in small font and written by lawyers who are paid to confuse you. But that is where the bodies are buried. Look at how they calculate the bonus. If it's based on adjusted EBITDA or revenue growth, regardless of profitability, run away. Is it based on return on invested capital? Now you might be interested. Return on invested capital is the only metric that keeps a manager honest. It forces him to answer the question, for every dollar of the shareholders' money I retained, did I generate more than $1 of value? Most of the S&P 500 would fail this test miserably if you stripped away the accounting gimmicks. They are destroying capital, masking it with debt, and paying themselves a royalty on the destruction. They are fighting a war against arithmetic, and as I have said 1,000 times, arithmetic always wins in the end. You can hide the rot for a quarter, or a year, or maybe even a cycle, but eventually, the tide goes out, and we see who has been swimming naked. And let me tell you, there is a lot of nakedness in the C-suites of America right now. Do not be seduced by the press releases or the charisma of the CEO who goes on television and talks about disruption. Look at the numbers, the incentives, and the share count. If the share count is going up, your wealth is going down. It is that simple. Investing is not about guessing which stock will go up next week. It is about partnering with people who you trust to steward your capital for a lifetime. If you cannot trust them with your wallet while you go to the bathroom, you certainly should not trust them with your retirement while you sleep. I would rather own a boring business, run by a boring man, who treats my money like it is his own, than the most exciting technology company in the world run by a buccaneer who views me as a source of liquidity. Be cynical, be suspicious, and for God's sake, learn to read the footnotes. Because in the footnotes, they tell you exactly how they are going to screw you. And if you read it and still buy the stock, then you deserve exactly what you get.